Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Welcome, everyone. This is Steve Meisinger, your host for today's ISE webinar. I'm pleased to have Jack Crooks with us, and Jack will be talking about making risk your friend and profiting from it using FX options. So Jack will be talking about what's going on in the markets and how you can hopefully take advantage of it. And that's the whole idea. But remember, when you're taking advantage of it, there's always risk in every trade. So you need to think about not only what you're risking, not only your potential reward, I should say, but your risk. And Jack's going to go through that and how important that whole issue is, risk and reward. But I'm really pleased as the host of the ISE webinar series to have Jack Crooks with me today, as Jack he just brings a wealth of knowledge, and I think you're really going to enjoy today's presentation. So Jack Crooks is the founder of Black Swan, and he puts out a news letter each and every day. I think you're going to really enjoy this presentation. Jack, thanks for joining us here at the ISE.
Thanks, Steve. Always appreciate it. Really, it's really great working with you and the ISE. You guys have just been great about, just presenting a quality product and doing the things on the education side like this is really great for customers and people that want to know this market. So we always appreciate the opportunity to talk and share ideas. And today we're going to talk about this idea of risk. The title here is Making Risk Your Friend. What's interesting about the currency markets are the fact that currencies are a relative game. The risk in one currency is an opportunity in another, and that's why when you see these clearly defined risk environments, if you can identify these clearly defined risk environments, you're going to have some trading opportunities in currencies. Sometimes they're short-lived, but sometimes you can define these environments longer term. And again, we say this a lot, and it really is true, and that's why we believe in this FX options product. For the average retail investor that doesn't want to be staring in the screens 24/7, doesn't want to be fighting the dealers short term, wants to make a bet on his macro view, his fundamental view, the kind of things that we do every day, we consider our fundamentals long term. You can do this with this product with limited risk, and if you're right, it really does pay off. So it's really a stress-free way of trying to trade what you see out there in the market in a very simple way, because it can be done in your regular equity account. So again, we think it's a great product for people that don't want to try and end up being intraday technical FX traders. You don't have to be. You can make money in currencies using this product, and that really is why we like it so much. So disclaimers. And basically the disclaimer is saying that really anything we do here really isn't a pure recommendation, at all. It's just we may talk about trade setups, but that's all they are. We're just trying to define some environments and give some examples of trade setups so you can think in those terms also. Titled this slide Risk Environment to try and just say that, as I said, people say, oh, if there's risk, we have to get out of the market. Well, again, you see that in stock markets. Risk comes in, everybody takes money off the table, and the trading isn't there. Things kind of go flat, go dull, because everybody's afraid to do anything. Well, that doesn't happen in the currency markets, again, because these are currency pairs. Something that's very, very risky in the world that may drive one currency down is by virtue going to drive another currency up. And that's why you have to really hop on these risk environments in the currency market for really great opportunities. And the key, of course, is trying to define these risk environments, and we'll get to that in just a second. Again, no rocket science here. The risk environments in the currency markets are the same as any other market, asset market. Fear and greed are the drivers here. And what is interesting, if you've watched stocks trade, you've watched bonds trade, other asset markets trade, you realize that fear is really the biggest motivator. Fear makes people move the fastest out of positions. So you'll see, for example, stock markets moving up, and it may take a couple years to peak, and then all of a sudden in 2 months, all of that 3 years can be retraced very, very quickly, which shows what a big motivator fear is to get out of markets. Again, if you think back to what I said, if currencies are a relative game, one currency against another, that fear move, getting out of one currency, means if you're on the other side of that currency, you're going to catch that giant fear move. Basically, you turn it into a greed move on the other side. So that's why you want to be in the game in these risk environments in currencies when you wouldn't necessarily be in the game in these other asset classes. Excuse me. If we had to define, there really are two major global risk environments to define these, and you may have heard these. They're becoming used more and more by your analysts on TV, and I think they're becoming more commonplace as definitions of the risk environments that we're in. Risk appetite. Risk appetite is that environment in which money's flowing freely out there, the subset of inflation. Asset prices moving up, money supply loose, everything's juicy-goosey, everybody's happy, seeing growth as far as the eye can see. That's the risk appetite environment. The risk-averse environment is a deflationary subset. Asset prices coming off. We're seeing wealth destroyed in risk-averse environments. People are afraid. They're deleveraging. They're taking money out of risky asset classes. So risk aversion is just the opposite of this. There are as I said, there are subsets of this, and there are different thematics going on within the markets, which we'll discuss some of those. But in general, these are the two major risk categories. And what you often see is on a longer-term basis, one of these may be in play, which we think about. But on a near-term basis, you're going to get ebbs and flows of risk appetite and risk aversion in a longer-term trend. For example, if the U.S. dollar may be in a long-term downtrend, and you would say it's in a downtrend because of a risk appetite environment, people are using the dollar-based credit to fund their risky asset investments around the world, which pressures down the dollar. But you're going to have those periods in the longer-term downtrend in a dollar in which you're going to get risk-averse periods, and the dollar is going to tend to rally when you see shakeups in markets. So you have to think of these in two different time frames. Long-term and shorter intermediate-term time frames. You can trade. You hear people say, "I'm trading against our longer-term trend." You can trade against your longer-term positions if you can identify these risk appetite and risk aversion flows, which I'm going to show you some examples of how to look at those and how to find those that I think you can do pretty easily yourself. If you're going to define those, you can trade against the trend. And again, why the FX option product applies so well in this environment. The FX options are listed on the ISE, go out to 10 months. If you have a long-term view of the risk environment, you can make a trade and take a small position trade there and hold it. And if you see things setting up near-term multi-week patterns possibly that go against your longer-term view, you can play those with shorter-term options and still hang on to your longer-term position using the FX option product. The reason you can hang on is because you know exactly what your risk is. If you buy a put or buy a call in this market, that is your risk. So that is the beauty of using these, to play the longer-term trends and also trade around your longer-term positions with shorter-term expiration options, 1 month, 2 months, 3 months, for example.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.